Good morning. Thank you for joining us today. As they say, the destination determines the quality of everyone's journey, and our journey is just starting. But what is life if we don't look back at what or how far we've come, right? So, our flagship product, Solitaire, has completed 4 years on the 30th of August. Today's presentation will be headed by Mr. G.R. Balaji, Head of Research and Co-Fund Manager. He'll be taking over from here. Thank you.
Hey, thanks, Tarun. My screen is on, right?
Yes, sir, it's on.
Yeah. Thanks for all for joining on a beautiful Saturday. So I'll run through on three important things. One, on the big picture. Second, our investment frame. And finally, how our portfolio is positioned. And then we'll take a Q&A, right? To start with, just give me a minute. The part one, the big picture. I think a picture connotes 1,000 words, right? I think clearly this picture clearly reflects what India is up to. On the left side, we are building a large infrastructure on the physical, and on the right, we are able to see, right, India has built a fantastic digital infrastructure, and now on the top, we are able to achieve a lot more coveted position, right, either in space or conducting the largest meeting out there as G20. So clearly, I think India is in limelight. India is in limelight for right reasons. We deserve to get, and eventually, I think we are getting it. So what this brings to us is, right, the data keep flowing, both good, bad, and ugly. From our point of view as an investor who takes decision keeping 4 to 5 years perspective, this is very important. Where are we in the journey as a country? And I think we are in an extremely good phase, fortunately. To support this data, right, on this picture, so let's share some perspective. The most important thing happening out there in the country today is CapEx. And if you look at CapEx can be driven by three entities. One is private CapEx, which we do. Largely, we buy residential house or car, or private CapEx, which the corporate does, but that will be very strategic in nature. But one entity can do CapEx, giving very long-term perspective, which is government, and rightly so post-COVID recovery, right? The big daddy, which is government, have taken in charge of putting the growth intact. And this one data clearly supports we are accelerating CapEx big time, and that's what getting reflected at the ground level. Significant growth in terms of the money spent by government to build country. Anyone wants to know where the CapEx is happening? I think just by traveling to Mumbai, you will recognize the entire Mumbai is getting reconstructed after 40, 50 years, right? Clearly reflecting India is getting reconstructed in that way. So one of the major capex area for our government is metro. I think it's a brilliant infrastructure from ease of traveling, from pollution, from cost and time advantage, right? Typically, it takes 300 to 400 crore to construct 1 kilometer of a metro, right? And pre 2002, which is 21 years back, we had only one metro, which is in Kolkata. And today, 18 cities in India has metro, and I think a lot more is coming up, right? So clearly, we know the big infrastructure projects are finally coming, and this is going to have a significant impact on a 5, 10, 15-year basis. A couple of more data in terms of how large our opportunity is. I'll touch upon few important things like asset management, right, which is part of a savings business where I thought as a house we are very, very bullish. If you see 2003, which is 20 years back, the entire AUM of the entire industry was 1.21 lakh crores. Today, there are a lot of mutual funds. Standalone has more than 2 lakh crores of assets. In 2013, it was only 7 lakhs. So from 1.2 to we moved to 7. But in the last 10 years, right, we have moved from 7 lakhs to 46 lakh crores. It means clearly you are seeing a substantial rise of mutual fund as an avenue for savings. But if you look at from a GDP point, India in FY24, we will close to 300 lakh crores. So we are roughly like 15-16% of India's GDP is what mutual fund. Global average is 70%. It means we have a very long runway in from a savings business point. There is one such data. So if you look at steel, right, a primary metal to construct the country, right? We were using 30 million ton, moved to 78 million ton in 2013. As per last year, we have moved to 125 million tons of steel. But if you look at China, right, our neighbor country, a very large country, and a large population, they use 1,000 million ton per year, right? Clearly 8 times more than what we consume. I think clearly the way we are building our infrastructure, I think we are going through that path. Even government has a target in the medium term, which is 2030, we will be close to 300 million ton, metric ton. Look at planes, right? Fleet size. Today we have 713 fleets, vis-a-vis China has 4,500, right? Why it is important to think with China is again the population of close to 140, 150 crores of population. Aspirations are very, very similar. So the opportunity size in India is too big. All we need is, I think we need to take a medium term call and stay invested in the right funds and right people. And then I think rewards are really, really good. What does this all brings in, right? With the growth put by in terms of capex as well as the opportunity, India will become very relevant to society. To put in perspective, in 1990 we were not even there in top 10 as a large economy. In 2000 also we were not there, but China appeared. In 2010, China became number two. India appeared into the top 10 league on the ninth rank. 22, we have already become fifth, and by 2028 30 the time zone we will be the number 3, right? So clearly brings in next 5-10 years India will be far more impactful, relevant to the society. That's where I think the big opportunity is coming in. So we were there in one of the AGM which just got concluded day before yesterday of an MNC. They are putting a very dedicated line in Pune just to export. So clearly reflects, I think India has taken a center stage in terms of investments, primarily from larger MNCs also. So having spoken about the broad picture that we are in a very good wicket, this doesn't mean there is no bad news, right? Bad news will come, like crude at 100, interest rates slightly elevated. I think these are definitely will keep coming. But I think the big picture is, I think we are in a fantastic position. The medium term growth is reasonably intact. It's all about now boils down to execution. Having said how India is performing and will perform, let's take the corporate India, right, which is again more relevant to investors like you and me. This is just a small snapshot of top 50 companies in India, how well they have grown the profit. The one thing which I want you to see is this green color, which is the highest profit ever these companies have reported in their lifetime. And if you look at the top 50, 26 companies have reported their all-time high profit just ending quarter June, which is TTM, or March ending year, right, which is 2023. Clearly reflecting corporate India is doing extremely well. And that is where our medium-term positive is there, right? So we have a country where economy is doing extremely good. Economy will become number 3 in next 5 years, and then we will become a very large economy in next 20 years. But it is not only economic growth, right? We have seen in many countries, economic growth doesn't translate into profit growth of corporate. But in India, you're clearly seeing the trend. Almost 1, 2, right? Every second company in corporate India have reported the best profit for their lifetime just ending now. Clearly reflecting corporate India is capturing the growth of the economy and delivering profits, which is more important from a long-term shareholders. So having spoken about the big picture, now let me touch upon how we think and what's a portfolio quant look like in Solitaire. So our investment philosophy is a function of 4 metrics. The first one is a long-term focus. I think clearly as a house, we consistently believe that we are very good at taking decision, keeping 3 to 4 years perspective. So we are clearly believe long-term is where the real money is there. So we take all decision keeping this 3 to 4 years as a time frame. The second one, we are typically a non-consensus investor. We are willing to buy into a great company going through a temporary problem, and then we are willing to ride it out. To put in perspective, post-COVID recovery, right? We had ITC at 220, 230, and we substantially had till couple of months back, right? So clearly reflects we are willing to invest into a good idea like an ITC, which was always a market leader in cigarette, a very good position in FMCG, a good position in hotel, and a good position even in other businesses, right? And due to COVID, it fell very sharply, and due to ESG concern, when we bought in, the dividend yield was close to 5%, right? Clearly reflects our non-consensus way of investing. This is one such example. There are many more. We are clearly a bottom-up investor from a philosophy point. Even though we look at the macro, global, India, we clearly believe, given we have 5,000 odd listed companies, right? The way to create long-term wealth is associate with good management, good business model, and invest at right price. So clearly, we are bottom-up. We go every stock by stock, and then we try to see does it fit into our philosophy rather than seeing from a top-down. Having said all these three, right, long term, non consensus, and bottom up, the final and the most important thing from our point is risk management. We clearly believe in an economy like in India, which is generally a growth economy. Returns are generally given, right? We can compound capital at a very good rate. What is more important is how do you compound capital? And when the tide turns, right, when the risk emanates come from global or domestic, how well you are protected your profit. This is where we believe having right risk control is more important and definitely very, very important if you're buying a small and mid caps. So this is the four investment framework and philosophy what we consistently added to the portfolio. So having spoken about the philosophy, right, now let's share some quants on Solitaire, which gives you an idea the way we think and operate. One of the data which I think most of the institution doesn't put out, but we consistently see, and it's important that as a prospective shareholders you should know is the type of business we own. Today, if you look at majority of owning is in B2C, which is 45, but we have a very good position in B2B, which is 42%, and the balance 11% into both B2B, B2G, right? So I mean, companies doing both B2C and B2B. Interestingly, so it's a very balanced portfolio of consumer facing and the business facing. And if you look at last incremental data, we are buying a lot more consumer because if you see in a B2B, was more to do with industrial products, capital goods, and so on and so forth. But last 2 years been a phenomenal rally. So off late, our tilt is towards buying into business where 5 to 10 crore customers are buying into the product. They have the market leadership and clearly extremely underpenetrated category, right? That's where we are slowly investing into it. So this is one. The number second, very interesting data which we consistently track internally and obviously, right, we thought we'll put out on our 4th year anniversary in terms of how well our portfolio is balanced. I told one of the very important metric we follow is the risk management, and the way we believe to manage risk at the portfolio level, not at stock level, is how well the portfolio is balanced among the high economically sensitive sectors, medium economically sensitive, and low economically sensitive. And if you look at Solitaire today, vis-a-vis last year also, we're extremely balanced in terms of today. We have 34% exposure in a highly economically sensitive sectors, which could be a capital goods, industrial company based on capex of the government. If you look at 33%, which is in the green, is typically a high consumer brand, which doesn't have any economic sensitivity. These are very daily consumed products or very necessary products, right? So if you look at our portfolio, the portfolio is prepared for any shock. That's a message. We are clearly building portfolio, keeping multiple economic scenarios can play out. And obviously, everyone knows, right? In next 8 months to 9 months, we'll have the large election coming out. So we are very well conscious of built a fantastic portfolio. It can withstand if at all there is any shock and then thrive post that. The one of the question keep coming is we do have a good exposure in small caps, but very interestingly, I thought I'll bring whatever of a small cap we own. It is also very important that not every small cap are common. So if you look at our small cap, we have 9 companies, which is 53% of the entire small cap which we own is MNC. So typically these are global giant. Their subsidiaries listed in India, and we have invested, right? So predominantly, they are part of financial services business, where a very large world number one, a $50-100 billion company subsidiary is based, which is not even a $500 million company in India, but they are small cap. But you know, right, the parent is too large. Or companies which is part of industrials, predominantly from Europe, very large industrial companies. We are market leader globally, and their subsidiaries listed in India, right? So we have a close to 9 companies, which is roughly 30 30% of the portfolio is MNC. So Solitaire is MNC dominated. If you look at another three companies, FMCG, and the balance eight is what mixed, right? So clearly we have a very high quality small cap, right? If someone is a little worried on the small cap rally, which we have seen it. Finally, as I told, our portfolio is one of the very low risk portfolio, and the one of the data which I would like to share is the amount of debt our portfolio carries, right? So if you look at in BSE 500, which is our benchmark, every second stock has a debt. Vis-a-vis, if you look at Solitaire, only 6 stock has debt, and out of 36, which is like 30 stocks in Solitaire are debt free. So 85% of the market on the portfolio value is a completely debt free portfolio. Only 6 stock has debt. Primarily, the debt has come from two portfolio has a big acquisition they have done. A few of them are going for a capex, right? So primarily, it's a growth-oriented debt. They are very strong in the current market position. So clearly, if you look at from portfolio quant point, right? I keep saying our portfolios are much lower risk than the market, and I think this data clearly brings out the amount of high quality portfolio we own in Solitaire, and that's what reflect, right? 30 out of 36 is completely debt free, and they have so much of cash. So to put all things in perspective, the Quants, it's a 660 crores portfolio as of last month end. As we speak, we are close to 680 odd crores. Flexicap, BSE 500 TRI, 36 stocks. So 36 stocks at the aggregate level. One of the biggest USP of Solitaire is we construct portfolio on a curated basis at the client level. So typically a client will have stocks from 25 to 30 on a broad average, and 36 at the aggregate, right? So 440 clients aggregately has 36, but at individual level, it's between 25 to 30. And if you look at the market cap split, large caps are 31-32%, mid cap is 9%, small caps are 57. But if you look at small cap, the average market cap of us is 9-10,000 crores. So it's not really small. That's point number one. And as I just shared the data, predominantly this is an MNC companies, right? So really high quality small cap is what we own here. Cash is very negligible. It's a residual. Portfolio ROEs are extremely healthy, close to 18%. Again, to put in perspective, broadly, Indian ROEs are close to 14 to 15, so very high on profitability. One more interesting data on the portfolio churn. As I told, right, we typically take decision on long term to support the philosophy, right? One evidence is the portfolio turnover ratio for our first client, which is a very good ballpark of 4 year, the way we have operated. Our portfolio turnover ratio is 15%, clearly reflecting we are trying to hold the stock between 6 to 7 years, right? Clearly reflecting the internal thinking of as long as you buy a good company and they consistently deliver good sales converting into profit to cash flow to dividend and free cash flow, right? We are willing to wait. And that's why the big rewards have happened. I'll show the returns. And the last on the risk is the portfolio beta. Our portfolio beta is 25% lower than the market. Again, right? Like I've shared the quants of the portfolio on debt equity. Now on the output, right? On the NAV performance, the beta of the portfolio is lower than the market. So market beta is close to 1, and our portfolio beta is 0.75, clearly reflecting a strategy of investing into high quality portfolio, take low risk and deliver higher performance. From a weightage point, our sweet spot is 3%. So close to 23 stocks are close to 3%, 3 to 5, 12, and there is only one stock, 5 and 10. So it's an extremely well distributed portfolio. Again, no concentration at one particular bucket. So one of the way it's very important to measure the risk is the drawdowns, right? When market fell, how did the portfolio behave, right? That's a clear reflection of each portfolio is able to withstand. And we are very happy to report to our shareholders in terms of on 20th June 2022, right? The preceding 4-5 months, the market fell 18% and Solitaire fell 11%, clearly reflecting our philosophy of taking a lower risk. And this is not one incident. Recently in 2023 March also, right? From Jan, the market fell close to 11%. The fund fell only 7%. Clearly, multiple incidents are clearly pointing on to one direction. Our portfolios are able to withstand extremely well in the down market. Okay, why it is very important is one, you protect the wealth what you have created in the up market. Second, your recovery will be very fast. So valuation, I think definitely at market is all-time high close to. So it is not a very easy market. Let's be very straight and clear. We had a very good run. I think last 3 4 years has been extremely a one-way street predominantly. So 50% of the portfolio is broadly in line, and obviously, right, 50% of the portfolio is slightly elevated. We keep thinking about where the valuations have gone. So one of the very large idea, which was a meme stock turned momentum stock, right? We're slowly trimming, right? It's clearly reflecting our philosophy of we are willing to buy the pain. We are willing to take the gain, huge gain from a rally of 140% in a large FMCG company. And finally, when the valuations have reached our beyond our comfort zone, we are willing to slightly walk off, right? That's our way. But the most important question, which any prospective investor or my existing investor should know, is in terms of where are we investing, right? So when if the stock goes slightly off the range, it's not necessarily that we have to sell, right? Because valuation is slightly very subjective. But when we invest, right, when the money comes into a portfolio, right, one of the very important principle we follow is we go by every single stock and see if we buy at this price, can we make the desired IRR, which as a house we want to achieve for our shareholders. And today, if you look at last 5 transactions in Solitaire, all the 5 is either we bought below average valuation or inline average, and there was no transaction where we paid up. So very clearly, even though we want to buy a high quality business, we want to buy at a fair price. Having seen the philosophy, having seen the portfolio quant, how well we can add value to you in a much better way at a portfolio level. The first one is I would like to run through quickly on the way we think about our decision making at the portfolio. I have shown you a lot of evidence on Solitaire, right, in terms of what type of portfolio we own, what is the downside metric, how well we have, what is the beta, and so on and so forth. Now, I would like to talk a little more on the way we construct the portfolio and the decision making. And these are 4 examples. The first one is during last year, we bought a small cap IT name. One, very interestingly, in the last 1 year, if you look at consciously, most of the IT companies have not done anything meaningfully. And there was no frenzy, right? It means clearly it was a non-consensus idea. So as I told, we are willing to invest into an area where it is non-consensus. So it's tying to my principle. What happened is fundamentals improved, stock price improved dramatically. In within a year, we are like 100% up in an IT space. So clearly reflecting, we are willing to buy the short-term pain to make a medium-term gain. That's point number 1. As I told in our first philosophy of being patient and being long-term, on the right side, on industrial consumable, right, this is one company where we bought in 2019. We're still honing it from the day 1 of the fund. But interestingly, for the first 3 years, the stock did not move, not even 5-10%, even though the fundamentals were slowly progressing. But we were being very patient. As our first philosophy of, right, we take decision keeping 4 to 5 years perspective. And clearly in the last year, when the fundamentals accelerated much better and finally market started recognizing it, the stock went up 200% in last 1 year. And then finally, if you look at our 4-year CAGR, worked out to be 32%, right? Clearly reflecting we are walking the talk in terms of being patient with a good company. This is an MNC company in industrial consumable, debt-free. They never did capex for last 10 years, and now they're doing 5x of capex what they have done previously, right? Large opportunity they are addressing, and that's where the excitement is all about. The third company again, right? So you have seen 2 things which has done extremely well. So now I'll talk about things where we have been a little more patient and we are bottom up. So this is a large general insurance company we own. Currently 2 years, if you look at premium growth has grown by close to 21% CAGR for last 2 years. So close to, after we bought, the premium growth is absolute level as 50%. One of the metric, right? One of the metric is premium growth. One of the metric is PAT growth. But definitely in the last 2 years, because of COVID, general insurance companies have gone through 2 pain point. One, they had more claims than the natural years because of COVID that hurt their profitability. Second, because of a lockdown, there's an intense pressure happened once the recovery happened in the auto space. So I think what we believe in is this is an extremely long story going through a very temporary problem. So we are willing to wait. The stock has not gone anywhere after our buying, which is 2 years, but fundamentals have improved by 50%. That's why I keep saying, as long as fundamentals are extremely robust and growing at a very healthy rate, we'll be willing to wait. And we have seen how the industrial consumable stock rewarded us. And finally, The last one is on the opposite side, where an automobile company, a very large automobile company, but being a non-performer in terms of we bought it for certain thesis which did not play out. But eventually, actually, stock price went up. But for us, we believe whatever we thought we bought in never happened in the last close to 2 years, and finally we exited. So with clearly this four, it brings you out, right, in terms of all the four philosophy of being long term, being non-consensus, being bottom up, managing risk is coming out with this example. The second example I would like to share at the portfolio level, how we would like to add value to our shareholders is in terms of how we buy specific stock at a client level and not an aggregate. So this is one FMCG company which we bought last year, a very popular South Indian FMCG company. So we like the name. We bought it at close to 17, 18 times multiple, right? Very, very cheap stock. Obviously, it was cheap for a reason. But interestingly, there was a change in management and then COVID came. So no one saw the effect of the new management. And we thought this management had a little more clear strategy about execution. We bought into the idea close to 160, 170 at 3%. And slowly, as we bought, the stock slowly started moving up only. So never gave it pain. That's point number one. It went to 220 very quickly. And we thought, okay, right, at this point in time, the risk to reward is slightly. So we moved to 2%. So all the new money which came in for the existing investor or the new investor coming into the portfolio, we bought only 2% of the same FMCG stock. And slowly and steadily, recently, the results came extremely solid. And stock today is at 350, 360. Post 280 to close to 300, we stopped buying it. So clearly reflecting the same stock, we were a buyer at one level, lot more. We slowed down buying, and now we are not buying. This is where we would like to reiterate, right? You can give money at any point in time. We'll be very conscious on the idea where if we buy today, can we make money for you? If at all that idea fits in, then we will buy in. Otherwise, we will not hesitate to buy. To put the evidence today, any new account, we are investing close to 40%. Day one deployment is 40%. So having spoken all the three, the big picture, the philosophy and the portfolio quant and the portfolio strategy, right, in terms of how we add value, what does a typical Solitaire client should expect in the 4 to 5 year term? You will see few big winners in the portfolio because we want to hold to long term. To give evidence, our first client has 30 stocks. He has 10 stocks more than 100% return, clearly reflecting we are willing to wait with the winners and we'll be very, very patient with winners. There will be definitely a very good set of optimum performer. From optimum performer is what we'll get big winners. So this will be the bulk of the stock. And definitely right, this is a game of probability. We will have few losers. The moment we believe the fundamentals are getting deteriorated, we will not hesitate to sell. So this is what sum and substance a client can expect, right? So you will have big winners, a lot of optimum performers, and potentially few losers. So how is Solitaire is positioned? It's clearly positioned for three mega trends. One, I think no better picture than what this financialization story, right, which Nandan Nilekani has put out as the last slide. Clearly, we are very, very high on financialization story. We strongly believe next decade opportunity is going to come from wealth management, asset management, general insurance, life insurance, and so on and so forth. We are very positive there. They are high free cash flow business, growing at 15 to 20% compounded, and they are very high dividend yield companies also, right? So we are very optimistic there. The second one is we are very, very optimistic on companies are becoming world champions. There are couple of names where they are world number one in the respective category, right? So we are clearly buying into business which is not only India champion or Asia champion, they are world champions. And finally, like how our PM is talking about Make in India, clearly there are big winners happening out of India growth, capex-led growth, and we are very well positioned. What's a fund positioning? We operate at a moderate. Even though the quality of portfolio is good, we do have a very substantial small cap, so it can be positioned as a moderate than conservative. But the return expectation, typically we think about average inflation should be a 5 to 6% and 700 to 900 basis over in the 3 to 4 year perspective, right? So clearly between 13 to 15% over a long period of time is what we would like to think about delivering our endeavor to deliver. To put this perspective, if you look at last 32 years of India data, Nifty and Sensex have delivered close to 11 to 12% on a very long period of time. So we think if we can deliver between 13 to 15 on a long period and taking 30% lower risk, I think it's a substantial outcome. I'll show how the numbers are, but this is our internal thinking and the positioning. You should be very, very clear on how we think and operate. Finally, right, the proof of the pudding in the eating, and I would like to happy to share what we have delivered in the last 4 years. I'll start with the right, which is the longest period, 4-year data. We have compounded capital at 25.10. We're very happy to report it's been an extremely challenged phase because when Solitaire started, we had COVID, so we went down sharply because we had a very large exposure in tourism and logistics and so on and so forth. But we came back slowly and steadily, and now extremely outstanding performance, I would say, right, across time period. If you look at BSE 500 TRI has done 18.91%. Nifty 50 TRI, just more of a large benchmark, 16.3. So very good performance. But the most satisfying thing is in the last couple of years, right? So if you typically take last 2 years and 1 year, where the broad index performance is close to the long-term average. As I told, India's long-term average is between 10 to 11. And I think last 1, 2 years, the markets have delivered close to that 9, 10, 11%, right? Whichever index we have to refer. Clearly, if you see, we have done far substantially higher, right? So for 2 year period, Solitaire has delivered 22.74 vis-a-vis markets at close to 9 to 10% odd, right? And this 22.74 is with low churn, low beta, low downside. So clearly reflecting, and it's in 1 year also, right? Substantial alpha. And I think the shorter period. I think whole idea is we strongly believe by consistently doing high quality investing at every client portfolio level, and then you just allow the compounding to take place, I think we'll be able to compound at a decent rate. So one of the questions keep coming is, okay, this is at this point in time, was the performance was very robust at March before this rally started or September? I think we're very happy to report again, the data has been very consistent. If you look at 30th September 22 performance, right? Solitaire 3-year was 1.95% vis-a-vis market at 18.37. Again, 300 basis over the alpha. Same at the March, and now it is even more better. Fund manager Sham, our founder, who was a veteran investor for 30 years. So with Sham, I co-assist with Sham on this fund. One of the very interesting thing is in the last 4 years, we have built a fantastic institution out there with leading from Sham, who is our CAO, fund manager for all the 4 funds. And again, co-managed by a couple of us. I am there, Balaji. So my other colleagues are Rohit, Rajat, and Niranjan, who takes care of various other products. We have a fantastic research team of 6 members, the strategy team of 4, and then investment team and product team. So clearly, right, the last 4 years, we have built a very good in terms of institution, in terms of to build the process clearly so that it is also repeatable for shareholders who is coming now. General quants, minimum investment is 50 lakhs. This is by regulation. Benchmark is when we launched, it was NSE 500. Now it will be BSE 500. Exit load is there. Fixed fee 1.5. That's it, right? Thank you. I think happy. Thanks, and we'll open the floor for questions. Request everyone to post the question in the chat box, and I'll start answering in a minute. Sorry, I'm audible, right? Okay, sorry. I told we can type in chat box and I'll take the question. So I'll start off with the first one. This is Kishore. What's your perspective on current trends in India and US market? I think our markets have done extremely well. As I've just shared the data, right? In the last 3-4 years, the index itself is compounding more than the long-term average, which is close to 10 to 11. I think from a US market point, if you look at macros of US is not in a great shape, right? Entire world is consistently going through this inflation concern, which led to high interest rate, which is going to slow down. I think what to expect fairly is the world will slow down. I think next 12 months, that's actually a given data. What we have to believe in is, I think India growth is extremely robust, and it's only getting better as the everyday passing. So we need to focus on control the controllable. I think that's where the opportunity lies. But definitely, as you rightly said, in terms of the global markets will have some more volatility because of the higher inflation led to high interest rate. Thanks for your presentation. View of general election coming up, we feel markets will be very volatile. You increase cash position? No, sir. I think I appreciate definitely with general election, this volatility can come up. But as a house, as I told, right, we are very clear, taking call 3 to 4 years perspective, investing into right stocks. And one thing you have to appreciate, in a lot of stock, liquidity is not available. So we cannot take a very tactical bet. We are a long-term investor, and I wish all the investor who is coming to I thought in any of the fund should have the longer horizon. I think elections are part and parcel of any investing, right? If someone would have told us before launching Solitaire, there will be 4 months out, COVID is going to come, people might die, the world will stop. Would you want to launch a fund? I'm sure it could have panicked all of us. And but you have seen the data, right? In the 4 year, gone through all the pain, still managed to deliver, right? So the idea is to you have to go and play the game. You cannot anticipate if market were to rise sharply, right? Then we will think we have missed it. So I don't think our core competency lies in what to expect out of market in the short term. Our core competency lies in identifying great business, buying them at right price, and holding on. To put in perspective, yesterday the AGM season just got over. As a house, we are very proud to share. We have attended more than 200 plus AGM collectively by the 10-member team, right? So clearly, we believe in control the controllable, do the hard work, try to find one good idea and invest rightly. So we don't want to take a cash call. It could be a very incidental where the market goes up sharply and we sell it, but that's nothing to do with if the election is coming and we want to take a cash call. That's why today, if you see, our cash position is close to 2%. And during March, there were a lot of concern on the market, right, due to upcoming election in Karnataka and the monsoon. A lot of institutions went to the cash call, but you saw what happened, right? From April till date, market just rallied one-way street. So these cash calls are two-way, very tricky. I don't think we are very competent to take cash call per se. But what we will do is, wherever risk reward is favorable, we'll stay invested. Wherever risk reward is not favorable, we will exit. The return presents are absolute. It's a CAGR, sir. The 4 year performance which I've shared is a CAGR performance, obviously, right? By regulation, any performance up more than 1 year has to be a CAGR return. Hope that answers your question, sir. Do you have any plan to invest in overseas market for the future? Not in this fund currently. In other couple of funds, we do take exposure through ETF format, but in Solitaire, it will be a pure 100% India-focused fund. Whenever we launch, we will let you know if at all on other fund, not this fund. Hope that answered your question, Shakti. Can you throw some light on customized portfolio? How is different from traditional MF investments? A good question, Balaji. So what happens in a typical MF investment is once the money given, right? Let's say tomorrow morning you give a crore rupee, the entire money gets deployed on day one, 98% fully invested into the same set of stocks, right? That's what happened in a mutual fund. Okay, the benefit is you get the full portfolio on the day one. But what we think is an ideal thing is that's what we do to client is within the entire portfolio, right? There are three things could have happened. There are portfolio which is expensive, there are portfolio which is neutral, and there are portfolio which is extremely cheap, right? So you will find all the three in everyone's portfolio from the existing client. So what we will do for the new client is we'll buy a lot more of the portfolio which is very cheap, which is already there in existing portfolio of the clients. We'll buy slightly moderate position in the portfolio where the valuations are okay. We would like to buy more if the price falls, right? So these are the two positions we'll buy for the new account. And clearly where we will not buy is the stocks which has become very expensive. Like today, to put it, our old clients have very good high exposure to capital goods because we invested 3 years back and these stocks are up 100, 200, 300%. Today, if I have to go and buy the same stock to you, right, I don't think we are going to make a lot more money for you. So clearly we are not going to buy there, right, for you. This is how we believe buying every individual account at their appropriate time when you give money. And because of customization, what is even more important is we actively engage with our clients. And as and when you keep giving money, right, we'll keep buying the new idea which is coming into our overall portfolio. So every individual portfolio is very customized. Even though the aggregate, that's what I told, right? Aggregately 36 stocks. Individually, every client will have between 25 to 30 in a normal basis. Hope that answered your question, Balaji. Can you please elaborate on exit load? Okay. So exit load is 3% for 1 year, 2% for second year, 1% for third year. After 3 years, no exit load. Hope that answer your question, sir. As the so exit load basically, right, you invest today and tomorrow you want to exit completely, right, you'll be charged an additional fees. Why do we do that is primarily, right, we want to be clearly engaged with people coming with a long-term perspective. That's the whole intent. Otherwise nothing much about it. It's a very traditional thing which is there in even in mutual funds. Hope that answer your question, Raja. As the broad market looks high, how do you plan to new accounts until election? I think again, right? So today we have close to 36 stocks. As I told, right, today the day one deployment is 40%. So we don't see this election coming in, right? There could be always a bad news which you can think, or some risk can keep coming. All we need to look at is, do we have a good idea which the growth is going to accelerate? As I told, right, if you look at ITC, one such example where we made big money, the last 2 years, the markets have not gone anywhere or it compounded at 9%. The stock doubled. So in a very flat market, also you can make a lot of money. The whole idea is if you find a good company which can grow the sales well, sales resulting in profit, profit to cash flow to free cash flow, right? Clearly you have a winner, right? All we need to see is, can we find a couple of ideas and then buy it at the right price? And we take anyway call on 3 to 4 years. So we don't clearly see elections coming in and then don't want to buy. As long as we find a good idea with a clear risk to reward in favorable to us, we'll be willing to invest. Generally, how long does it take for a portfolio to become 3x in size of an individual investor? I think so. If you look at a 15% compounded, right, every 7, 8 years, the portfolio of a crore should become a 3 crore. That's what the endeavor. But what we have delivered, as I told, right, we have compounded capital at 25%, which is every 3 years you will double, right? So, but I think you should come with a medium-term expectation of 13 to 15%. That's where. So ideally, 3x should be a 7, 8 years sort of a time frame. And if you look at markets, right, market takes between at a 10, 11%, it will take 10 to 12 years to compound capital at a 3x, a crore becoming a 3 crore, roughly. Hope that answers your question, sir. How are you seeing finance sector in future horizon of next 2 years, especially about the banks? I think I would just like to tell we are very positive on banks, but in Solitaire, as a strategy, conscious strategy, we don't invest into leverage business. So there is a zero bank. It's one of the biggest USP of Solitaire is it doesn't have any bank. So clearly, we have a lot of financial. As I told, we have a very large exposure to asset management, general insurance, life insurance, wealth management, and so on and so forth. But we are very positive on banks. Banks are primarily a leverage business, play on economic growth. I think India is extremely well poised to become the third largest economy, right? If India is becoming third largest economy, if bank doesn't support, I don't think India will become third, right? So it's clearly play on economy. But if you have to also see, bank is a low ROE business. Typically, they make a return on asset of close to 2% and leverage of 9 times. The return on equity can be anywhere between 15 to 20% with a 6 to 7 times of leverage, right? So these are very high leverage business, very important industry. We are very positive in one of our fund, which is a flagship fund where I co-fund manage on True Blue. We have very high exposure to private banks. They are very well positioned both from capital growth on low NPA in the decade, right? So clearly we are positive, but in Solitaire, we don't have zero banks. Where do you find the historical high, low, median PE of a stock? It will be there in both at the NSE site and obviously, right, we use a couple of platforms like Ace Equity. If suppose we join the Solitaire team, how much cash will be deployed for the new client? Also, how much horizon for full deployment? A very good question, sir. I think typically, as I told, the day one deployment as on day before yesterday is close to 39 to 40%. So we are able to deploy 40% of your capital on the day one deployment. And typically, we think it should take between 3 to 4 months time frame for us to deploy reasonably like close to 90% sort of our money. Unless if market really panics and falls sharply, we will accelerate. One thing will be very clear, we will buy when the market gives us a window, right? In terms of, so if market were to fall tomorrow sharply for next 10 days, right? I think we will accelerate our deployment. I think that's our strategy. Our deployment is very function of, we have a portfolio weight for every single stock. and we have an IRR for every single stock at the portfolio level also, right? So as long as we think we are going to get the desired IRR from that stock and the fall is happening, right, we will be able to accelerate. So typically day one is 40, and on a 3 to 4 month period is what we will be likely to complete investments. Hope that answered your question, sir. I understand the return presents are after expenses. What about tax? So tax is general. Every returns are generally shown in pre-tax, like in every individual. You have to file, and I think our team will support in terms of documentation side. In terms of every year, we will give us audited this one. But like an equity, right? Long-term tax applies to the long-term, and if there is any short-term trade, short-term capital gains get applied. If we want to start our SIP in S&P or Nasdaq, can we start or should we wait out? I think we are neither positive on this both currently, and I think it's a slightly different question of topic. But SIP as such is a good way to accumulate any asset class. So there is nothing called right time or a wrong time, but you should have a view on the asset class. And currently, as a house, we are not very constructive on the global market, so that's where it ends. Adding further, how much SIP will be fine? 50 lakhs fully invested is expected. I think another good question, sir. So typically, what we encourage our investors is, right, investment is a function of two people. Primarily, one is investor, one is the fund team. I think when they're both aligned together, I think there is a fantastic experience. And one of the way we want to build a fantastic performance is expecting client to contribute capital at some point in time. If it is SIP, nothing better than that, right? What it gives is it gives line of sight for the portfolio manager about the cash flow. So I think the ideal endeavor is if you can deploy aggregately on a 50 lakh, a 10 lakh rupee over or a 12 lakh rupee over an entire year, right, which is like a 20-30% of a incremental capital per year basis, which could be a 1 lakh per month, or let's say on a quarterly you can give a 3 lakhs or a 2 lakhs, whichever convenient to you. But all the thing which I expect is come with a 3 to 4 years horizon, and have that window. I think that money can always come in, and we'll be very, very conscious on deploying, as I told in the beginning, on particular stock where the valuations are attractive and not in general market. So today we are buying this general insurance company, which is trading at 14,000 Nifty, right? So today Nifty is close to 20,000 or 19,500, whichever the number we can refer to, right? So we are buying companies which is close to 14,000 Nifty, which is not participated in the entire 2 year rally, right? So we will be buying stock specific and not at the aggregate market level. Otherwise, a lakh per month will be a great option. Even lesser than that, it will be also an ideal. But SIP is a fantastic, nothing like that. Hope that answer your question, sir. If new client doesn't have cash, if he comes with portfolio fully invested, how it will be handled? If it comes with a portfolio fully. So if we are fully invested into the portfolio, as and when we have an exit, we exit a particular stock. For us, exit is a separate decision and buying is a separate decision. So when we exit and we have cash, we look into our portfolio stocks, we look at our pipe stocks and see is there any good idea which can fit into your client account and then buy into it. If the money comes from the separately, we will buy. So we will not sell because of we have to buy a new idea. So if your question is, if we get a new idea as a house, but the portfolio is fully invested for you, will you sell something to buy? No. We will sell independently, right? So the selling decisions are very, very independent. Once we sell and we have a cash, we look into search of an idea. Or if client gives money and we have a cash, we'll again look into an idea and deploy more, right? That's where we have 36 at aggregate and close to 25 to 30 at the individual level. Is particular redemption allowed for incremental amount above 50 lakhs? Yes, very much, very much. Now, all that is possible, sir. A regulator says you have to maintain 50 lakhs. So let's say we go to 2 crores, and you want to take 20-30 lakhs for any need. I think it's most welcome. Just that you need to be sure on did you cross your exit load period and so on and so forth. Otherwise, the entire market is extremely liquid. One question last is 36 stock. Is it not too many over diversification? I think this over diversification or concentration has its own, right? So 36 is aggregate. So at the client level, it's 25 to 30, right? So we are like typically 3 to 4% in every idea. We think, and this has been a bull market, right? Market has not given opportunity even to consolidate the portfolio. I think it's a good number. It's a sweet number. At a client level, what you need to look at is my return expectation is getting met, and is the risk of the portfolio is lower, and is the portfolio manager is walking the talk. I think we are coming to make money, right? There are global fund managers have done with 200 stock, right? So just put in perspective, India's largest small cap fund manages more than 150 stocks and being the top performer, right? So I think being concentrated is a great way, or diversified is bad. No, that's not. I think there is always a comfort zone. We believe as a house, we think 25 to 30 is a good position. It is actually very concentrated in a way. A typical mutual fund owns 70, 80 stocks. So I think having 25 to 30 is not diversified to an extent. 36 is an aggregate. The 440 clients put together is 36. At individual level, it will be between 25 to 30. Few of the clients are little more. And if you have to think about in the last 3 years, the market is one way direction, right? So you're not able to buy a lot of position because there is market is just rallying it. I think in a very flat market, coming bear market, I think ideally 25 to 30 is our good number at client level. Aggregately, we might have more, right? As I told, I'm not buying the FMCG company which we bought last year. So that is there at aggregate portfolio, but that will not be part of your portfolio when you invest tomorrow morning, correct? So that's where. But in PMS, managing capital gains, dividend and tax compliance is a problem. I don't think so, sir. We have a very robust system. I think any investment you have to first look at is the portfolio manager is delivering performance and delivering with low risk, right? I think we are very happy to share that this is one of the very credible number in India, right? On a 4-year 25 with 0.75 beta, and it is not very cumbersome. We'll be very happy to assist if you have any issues on that. Sir, how do you see Solitaire theme in next 5 years? Will idea theme change based on market dimension, like AI now going all around with your idea stage? Sir, I think all about is making money. We will not get colored because of some fancy words keep coming. Because if you have to look at solar energy or so many things stuff, right? There are a lot of conversation, but finally you need to ask, is the company has a good business model where they can monetize it, and they don't monetize only this year, right? 5-year, 10-year, 20-year, and his market is not appreciating, right? One, you need to identify good company, but if you buy a good company at 80 multiple, I'm sure you know what happened, right? There are a lot of institutions in India paid 80, 90 multiple saying these are the monopoly company and no one can touch it. I think last 3 years, they completely missed the bull run, right? We are very, very clear. You cannot buy a high quality business by 80, 90 multiple. You have to buy it at 20, 30 multiple or right multiple for the right growth. So I don't think we want to chase any stock like that, but we are definitely cognizant of ideas like AI, which can have a vast impact. So let me give you some example of high-tech bio companies can do a lot more testing in the lab now using technology. It means they'll become very productive, right? So we can actually play the productivity coming out of AI in some other company and not a pure AI company, because there could be thousands of large company. It's a very early days, but definitely we are watching this trend, and obviously if we find good opportunity at the right price, we will not hesitate to buy. But otherwise, what's our promise in 5 years is simple. We will buy high quality company. We will buy for long term. We will take lower risk. And as I told, our endeavor is to deliver between 13 to 15% for a very long period of time. Having said what we've delivered, I've shared the numbers. Numbers are there in front of you. Hope that answered your question, sir. Does the dividend from stock held in portfolio comes to reinvest? It will be reinvested in the portfolio. It will come into our account and it will be reinvested in your own portfolio. Hope that answered your question, sir. Due to portfolio churn. So the reinvestment, yeah, it will add up, but otherwise the money will come into the account and we will invest back the money into the portfolio. And a typical dividend yield is close to 2%, which is very, very healthy, right? Clearly reflect we buy high quality business there. Thanks for the patience. Your response is clear and fine. Thank you, sir. How do you think about upcoming account aggregator framework would help the financialization theme, say for insurance, wealth? Can you comment on banking space? Absolutely. I think we are building a fantastic digital infrastructure. What account aggregator will do is it's going to disentangle the credit market. So if you have to look at, we save money in savings account at 4%, 5%. Then there is an operating cost, there is a credit cost, which could add up 3%, right? So 5 plus 3, 8. If the bank is lending someone at 18, 20%, right? So they pay 9% and they get 18%. They make 9% margin, right? Huge margin. I think what will account aggregator will do is the data will get disintegrated. It means people who want to underwrite risk, the data is going to be available to them, which was not the case a couple of years back. And with this data, someone will underwrite the credit at a lower premium. It means from an end user point, we are going to get cheaper credit. From a banking point or from an NBFC point, there's going to be a lot more competition. If you are going to your product yield is very high, right? Where let's say gold loan charging 24%, I think that will come off. Lot of data getting disentangled. We are going to get a lot more data. We will see very close to ideally 400, 500 basis over the corporate rate. So today corporates can raise capital between 8 to 9%. At 12, 13, people should raise, right? Not at 24. I think it's going to have a big impact. Definitely a very large initiative taken by the government. And I hopefully it's going to help a lot of consumer. It's going to help consumerism. It means instead of we paying a 24% loan, we are going to pay a 12% loan. It means we are going to pay less EMI. So that money will be available for us for the consumption. I think it's going to be a big beneficiary, and the larger banks will play a bigger role because the people who have cheapest deposits is going to be the key, and that's where the large private banks and few large private banks, public banks, are very well positioned. Hope that answered your question, sir. Thanks, Balaji, for clarification. Very insightful. Thank you, sir. In some of that company are at 52-week low, we are still in the stock or exit. Good company will like. No, I think 52-week is a very good indicator that stock can potentially cheap and not necessarily cheap. I think these are two very distinct things. What has gone down is not necessarily a cheap stock, right? A bad stock eventually will go down. So I don't want to comment on a particular company like a good company, like whatever the name you have referred. I think we have our own metric in terms of how a company should be well run, how much free cash flow they should generate, right? So what do we see in? I think if we find any good company today at a low valuation will be very attractive. To put in perspective, as of last 10 days back, 52-week high list was 100 plus company and 52-week low was only 2-3 company. So clearly, right, there are not many. If at all they are falling in a rising market, clearly the fundamentals or maybe some governance issue and so on and so forth. So we have to be very careful, but definitely right. A fallen stock is very, very, it's a very good starting point to research and not the end point. Hope that answered your question, sir. If you find a debt-free, high-quality company generating a high ROC, free cash flow, 52-week low, like we bought one of the asset management company at 52-week low with 5% free cash flow yield. All our existing clients have that position. Today the stock is up 50%, right? So we will buy, but we have to buy such company and not weaker profile company. Hope that answered your question. Thanks, sir. Okay, thanks all. I think for the patient hearing. Hope we added some value. Looking forward to your support. Do reach out to us if you have any other requirement on the fund side. We'll be happy to assist. Thank you. Tarun, we can close it formally.
Thank you, sir. Thank you for the presentation. Thank you all for coming. Hope you had a really insightful session. Thank you.